$0. From $100 billion in assets to absolutely nothing in a matter of months. That sounds like a pretty bad deal, right? No. The 2008 financial crisis might just be one of the most studied economic events ever. But one thing always confused me: the speed of the collapse. I mean, how did a legendary Wall Street bank just disappear overnight, and why did nobody see it coming? So let's tackle that question. In this video, we're going to explore the story of Bear Stearns, the first domino to fall in the 2008 financial crisis. So buckle in, it's gonna be an interesting one. So before we go into the details, there are a couple of basic facts that we should be using in this video. The story of Bear Stearns isn't just about numbers, it's about people, risk, and a warning that everyone ignored. For decades, Bear Stearns was a titan of Wall Street, known for its aggressive, scrappy culture. They were the outsiders who made it big, but their hunger for bigger profits led them down a very dangerous path. By the way, financial geniuses are supposed to be so smart and efficient, so the choice to bet the entire firm on risky mortgage-backed securities always escaped me. But I digress. The collapse wasn't a single event, but a series of dominoes. The more we understand each one, the clearer the picture of the 2008 crisis becomes. Okay, let's get started with the first sign of trouble. Fans of financial history will know that the seeds of disaster were sown long before the bank actually failed. The first major red flag came in the summer of 2007. A full 9 months before the firm's demise, Bear Stearns managed massive hedge funds that were heavily invested in subprime mortgage securities. These were complex financial products backed by home loans given to borrowers with poor credit. For years, as the housing market boomed, these investments were like a goldmine, generating huge returns. But when the housing bubble began to wobble, the value of these securities plummeted. In June 2007, the first fund, the high-grade Structured Credit Strategies Fund, reported catastrophic losses. Lenders who had provided the fund with money started demanding it back, a process known as a margin call. Bear Stearns tried to bail it out, injecting $1.6 billion of its own money, but it was like trying to plug a dam with a finger. It wasn't enough. Just a few weeks later, in July, both that fund and its sister fund, the high-grade Structured Credit Strategies Enhanced Leverage Fund, were completely wiped out. Investors lost everything they had put in, a total of $1.6 billion. The firm itself lost another $1.9 billion from its bailout attempt, a total loss of $3.5 billion from just 2 funds. This should have been a 5-alarm fire for the entire financial industry. It was clear, undeniable proof that the subprime mortgage market was toxic. Yet, the CEO of Bear Stearns at the time, Jimmy Kane, famously downplayed the issue. He was reportedly more focused on playing in a bridge tournament than managing the crisis unfolding at his firm. The market, for a brief moment, got spooked, but then, unbelievably, it calmed down. The wider world seemed to think this was an isolated problem, a small fire that Bear Stearns had contained. They couldn't have been more wrong. This wasn't just a warning shot. It was the first crack in a foundation that was about to crumble entirely. The final, terrifying freefall happened with breathtaking speed. It was a 10-day death spiral that began in March 2008. On Friday, March 7th, Bear Stearns stock closed at a respectable $62.30 per share. While this was down significantly from its peak of over $170 a year earlier, the company was still valued at over $7 billion. To the outside world, it was a wounded but still viable Wall Street giant. But inside the financial system, a silent bank run had already begun. Other banks, hedge funds, and clients were quietly pulling their money and their business away from Bear Stearns. They were terrified that Bear's exposure to those toxic mortgage assets meant it could collapse at any moment, and they didn't want to be caught in the wreckage. By Monday, March 10th, the rumors were swirling. The stock dropped to $57. By Wednesday, March 12th, it was clear this was a full-blown crisis of confidence. The stock plunged another 20% to close at $46. The firm was hemorrhaging cash, unable to borrow the short-term funds it needed to operate day-to-day. On Thursday, March 13th, the firm admitted it had a severe liquidity problem and that its cash position had significantly deteriorated in just 24 hours. The Federal Reserve and JP Morgan Chase had to step in with an emergency credit line just to keep the lights on for another day. But the news was out. The stock crashed to $30. The next day, Friday, March 14th, was the point of no return. The stock opened in a freefall, hitting $20, then $10, then dipping below $6. The company that had been worth $7 billion just 1 week prior was now on the brink of complete annihilation. By the end of the day, it was clear Bear Stearns would not survive the weekend as an independent company. The death spiral was complete. In just 10 days, a pillar of Wall Street had been reduced to rubble, its stock price journeying from stable ground to mere pennies. A shocking testament to how quickly confidence, the lifeblood of banking, can evaporate. With the firm utterly insolvent and the entire global financial system at risk of contagion, the US government orchestrated a desperate, last-minute rescue over a single weekend. The buyer was JP Morgan Chase, a larger, more stable rival. The negotiations were frantic, driven by the fear that if Bear Stearns filed for bankruptcy on Monday morning, it would trigger a chain reaction of failures across the globe. On Sunday, March 16th, a deal was announced. JP Morgan would buy Bear Stearns in a fire sale. The original offer price was almost insulting, $2 per share. Think about that. Just a year earlier, the stock was trading at $170. 10 days earlier, it was over $60. Now, the price was less than a cup of coffee. The deal valued the entire 85-year-old institution at just $236 million. This was a brutal, shocking valuation. The headquarters building alone, a gleaming skyscraper on Madison Avenue, was estimated to be worth over $1.2 billion. JP Morgan was essentially being offered the entire company for less than the price of its own building. Bear Stearns shareholders were apoplectic. They felt it was a complete lowball offer, a hostile takeover facilitated by the government. The backlash was so intense that days later, the deal had to be revised. JP Morgan, under pressure, raised its offer to $10 per share. This new price brought the total value of the deal to around $1.2 billion. It was a significant improvement from the initial offer, but it was still a devastating blow. It represented a staggering 94% loss for anyone who held the stock just 2 weeks prior. The fire sale was complete, and one of the most storied names on Wall Street was absorbed by a competitor for a fraction of its former worth. The message was clear: no one was too big to fail, and the price of failure was absolute. But even the revised $10 per share price wasn't enough to convince JP Morgan to take on the massive risk of Bear Stearns as toxic assets. They were terrified of what they might find lurking on Bear's balance sheet. To get the deal done and prevent a global meltdown, the US government had to step in with a massive financial sweetener. This is where the Federal Reserve, the central bank of the United States, made an unprecedented move. The Fed agreed to provide a special loan to facilitate the purchase. Here's how it worked. The Fed created a new entity, a limited liability company called Maiden Lane LLC. This entity would buy up $30 billion of Bear Stearns' most toxic and difficult-to-value mortgage assets. To fund this purchase, JP Morgan would loan $1 billion to Maiden Lane, taking on the first $1 billion of any potential losses. The Federal Reserve itself would then loan the remaining $29 billion to Maiden Lane. In essence, the US government, and by extension the American taxpayer, guaranteed $29 billion of Bear Stearns' worst junk. This guarantee was the crucial element that made the deal possible. It protected JP Morgan from the catastrophic losses that could arise from these assets, effectively socializing the risk while privatizing the company. It was a controversial move, and many critics called it a backdoor bailout. They argued that the government was using taxpayer money to save Wall Street from its own reckless decisions. Supporters, however, argued it was a necessary evil. The alternative, a disorderly bankruptcy of Bear Stearns, was simply too terrifying to contemplate. It would have frozen credit markets and likely triggered a far deeper and more painful recession. This government sweetener wasn't just a footnote. It was the key that unlocked the entire deal, setting a precedent for the much larger government interventions that would follow later in 2008. While the headlines focused on the billions of dollars and the high-stakes negotiations, the true human cost of the collapse was felt by the thousands of Bear Stearns employees. Their devastation was swift and absolute. Unlike many other Wall Street firms, Bear Stearns had a unique culture of employee ownership. It was a point of pride. From the top executives down to the administrative assistants, a significant portion of their compensation came in the form of company stock, which they were often required to hold for years. It was their retirement plan, their children's college fund, their life savings. In fact, at the time of the collapse, employees owned roughly 1/3 of the entire company. This meant that when the stock price went to zero, it wasn't just outside investors who were wiped out, it was the firm's own people. They watched their personal wealth, built up over decades of hard work, evaporate in a matter of days. A mathematician on Wall Street might be able to calculate the total loss, but the human toll is harder to quantify. Imagine being a 60-year-old partner who had planned to retire with tens of millions of dollars in stock. only to be left with virtually nothing overnight. Or a secretary who had diligently saved her stock awards for 20 years, seeing her nest egg disappear. The stories were heartbreaking. People lost their homes, their security, and their sense of identity. The firm they had dedicated their lives to was gone, and so was their future. The total wealth lost by employees is estimated to have been in the billions of dollars. This wasn't just a financial loss, it was a profound betrayal. The aggressive, risk-taking culture that had made so many of them rich was the very thing that led to their ruin. The collapse of Bear Stearns serves as a brutal reminder that behind the abstract numbers of the stock market are real people with real lives and real savings. And for the 40,000 employees of Bear Stearns, the fall of their company was a personal financial catastrophe from which many would never recover.